Vantage scores to enter the mortgage market, credit Sesame claims to go public, and an Illinois debt collector gets in trouble by violating the FDCPA. All this and more on another exciting episode of Cup of Joe. So let's start off with the Vantage score or Vantage scoring systems to enter the mortgage market. And all this happened because the Federal Housing Finance Agency, the FHFA, issued a public and final rule on allowing alternative credit scores to enter into the mortgage space because, for the most part, FICO scoring has had the monopoly over the industry. They've been the predominant player supplying credit scores to the mortgage industry, the auto industry, the credit card industry. FICO has been around since the 50s, and they've probably been the most trusted, but also could be because they've probably been the only one around. They pretty much own this credit scoring space. Well, Vantage didn't really like that too much. In fact, of course, their idea, the whole business model is to compete with FICO and be an alternative, be another option to FICO scoring, that lenders would have another option to use, a different scoring system to use. And their angle is, FICO is missing out on a lot of people. A lot of people in the U.S. aren't scorable due to these factors, which we'll get into in a little bit. And hey, here's a wide population, millions of people who are scorable, who could get a mortgage loan with you or could get an auto loan with you, but you're not able to give them a loan because FICO isn't scoring these people. And so that's been Vantage's main angle in their way to compete with FICO is by allowing that. Now, they have really not been able to enter in the mortgage space. Fannie Mae, Freddie Mac have kept a tight lock and only using FICO scores for the mortgage market. And so Vantage obviously has been contesting this and really trying to fight to get a ruling here, to get legislation to allow them to enter the space and compete. And it looks like that has now been accomplished. And so the FHFA published a final rule in August that's going to allow for alternative scoring models. So with that said, it's not just Vantage. They're not just saying Vantage, you alone can now compete with FICO. They're bunching up Vantage with alternative scoring models. Now there's several other different scoring models, and it allows now the way for other companies that exist outside of Vantage or FICO to compete in this space, and other companies that are out there to develop alternative scoring models and to compete with FICO in the mortgage space. Now, this is going to take some time, because FICO, for the most part, has owned this space for quite some time. And mortgage lenders have been using older versions of FICO. They're using FICO Classic models, version 2.0 for Experian, 4.0 for TransUnion, and 5.0 for Equifax, also known as Beacon 5. So they've had these classic versions of FICO, and they've been using the FICO versions, these older versions of FICO for quite some time. And quite frankly, it's probably because they're used to it. It's the most trusted, with the exception of what happened in 2007, 2008. That really doesn't have a lot to do with FICO. That really has to do with more with independent decision making and independent, policies that were in place to allow a lot of consumers who have, no income, no verifiable income, rather, not verifying income, allowing credit scores as low as 500 to enter into a mortgage agreement and secure property. That really doesn't have anything to do with FICO. It's more of just with the independent bad behaviors of the mortgage market, mortgage brokers, and so on and so forth. But FICO, for the most part, has owned this industry, been around for quite some time. And so the FHFA presented standards and criteria and a process that Fannie Mae and Freddie Mac will use to validate and approve other credit scoring models. And so they're not saying, hey, Vantage, you can go right in and now compete. Before they actually are adopted by mortgage lenders, they have to verify and validate themselves that they're going to be a better scoring system or a great alternative scoring system. They're not going to be that risky. Obviously, at the end of the day, what we're trying to prevent is another 2007, 2008 crisis on our hand. And so they're really needing them to go through a process and validate. So the final rule is going to be effective October 15th, 2019. And the FHFA believes that this process of approving the alternative scoring model may take up to 26 months. They're kind of basing it off of previous histories in the past with FICO and other FICO versions, in order to approve it. It's going to take some time to get there. And then once the model has been proven, then the score model to be adopted by the mortgage companies, the mortgage industry, is going to take probably about another 18 to 24 months, also based on previous history. Now, it may not take as long, but just kind of judging it based on past experiences, what the FA are going to require to validate their model is going to take about 26 months to get there, up to 26 months, so it can happen sooner. And then for the mortgage industry to also adopt it themselves, because that's the other part of the equation, is because once they get the FHFA to validate the model and approve the model, that's their score model, then it's up to the market, right? It's up to the mortgage investors, the lenders to agree and accept and participate in allowing or choosing Vantage as opposed to FICO. So my opinion, how this is going to go down, or what Vantage has to do to convince mortgage companies or investors that their model is just as good, if not better, than FICO, is showing them how many more approvals or how many loans they could do that they couldn't do because the applicant did not have qualifying FICO scores. And to qualify to have a FICO score right now is you need to have at least one trade line, or a credit card, or revolving trade line, installment trade line, one trade line on the credit report that is not disputed, that has been updated in the last 6 months and has reported for at least 6 months in order to generate a FICO score. To get a Vantage score, you really just need to have a pulse, really just an inquiry, then you have a Vantage score. So Vantage is pretty much scoring this population. And to be honest, the people that are within this population, the FICO score, the people who don't have a FICO score just yet, those are going to be people that consist of maybe students or college grads or high school students that are just starting to, start to use credit and starting to take it on, but haven't really, done enough transactions yet or to have enough credit history to justify or to generate a credit score. Also probably part of the population that doesn't really use credit. Maybe they've used credit long ago, but, shied away from it. They've been kind of dormant for quite some time. That's typically going to be most of the market that makes up the non-scorable market and FICO scores that Vantage can score. And so they have to convince also the mortgage lenders, like, hey, here's some people here that could qualify for a home loan, like the student who just graduated, got a job, and just started building credit, or the gentleman out there in Nebraska who hasn't really been using credit for quite some time. They've been dormant and they don't have a FICO score anymore. They have a Vantage score. These are applicants that you should take in, you should really consider, and they would be worthy of your product, because FICO couldn't score them. We can, and we can give you a true score around these people. And so, of course, when this happened, FICO is going to obviously kind of compete in that. They came up with a newer version. I believe it's under FICO 9 or FICO X, that they're coming up with. They came up with a score model to compete directly with Vantage with this. No one's really adopted it, but they have it kind of in their back pocket to go to in the moment that Vantage gets traction here and starts to gain some market share. FICO can come in and say, okay, cool, you like Vantage score model because of that. We have the same thing, so what? Let's come to us. We're better, right? More trusted. And so this is the process that Vantage is going to have to go through to get mortgage companies to be convinced to switch from their FICO scoring model and start picking up Vantage scores. Another thing, so that could be attractive to loan originators. Mortgage loan originators can look at it as, okay, out of every 30 applications I get per month, I approve, 5 of them. But with Vantage is showing me I can probably get 7, maybe 8, more applicants and maybe do 2 or 3 more deals a month. So to the originator who doesn't really deal too much with the back end, doesn't care too much about it, but to the back end, that could be appealing to the originator and maybe to the business as a whole as well, because they're doing more volume. To the investor who incurs the risk, maybe not so much. Maybe their concern is going to be, we know what the risk is with FICO scoring applicants who apply using a FICO score model, and what the odds are of them not paying on time. And it's a very trusted source. We know what the risk is, and we know how to mitigate that risk. Vantage is going to have to do the exact same thing and prove that they're not as risky or less risky, or on the same level of risk with FICO, in order to get in the investor side of things, the person that's holding the loan and servicing the loan, to consider that this is definitely something we should really consider. Because what the FHFA is stating, that a mortgage company is not going to have the option to choose, they have the option to choose, but they're not going to have the option to have both. Okay, they can't have one application come in, a consumer is applying for a mortgage, and they say, okay, well, you didn't qualify under a FICO score model. We're going to go ahead and run you through a Vantage score model so we can get you approved that way. It's not going to work that way. Once the mortgage company has selected which model they want to use, they're going to have to stick with that, and they can't hop around. They're going to have to pick one and stick with it. They didn't really specify how long, if they even have an option to revert back. Let's just say they don't like the Vantage score system, they want to move over to FICO. They didn't really specify, at least yet, or at least they haven't really revealed that just yet. I'm sure it's out there in a policy within Vantage or within the ruling, but stating that if they can switch it back and revert back to FICO. But once they have selected what model they switch to Vantage, they have to stick with it. They can't have both. They got to do one or the other. So Vantage has in other scoring models, not just Vantage, they have their work cut out for them. This change is going to come. People are going to, I think mortgage companies are not, it's not going to be 100% are not going to switch. There's definitely going to be some mortgage companies, willing to switch and try a different model. It's going to happen. The market will respond. Will it go from 100% moving away from FICO going to Vantage? I don't think so. Could it be 50-50? Probably not. Could it be maybe 70-30, 80-20? Probably, right? I do see Vantage getting quite a bit of market share here. But, again, FICO's that known brand, that trust brand, has been around for such a long time that it's going to be tough to pull people away, pull businesses away from FICO. Because we're not talking about, pizza or a restaurant or a new beverage where there's very little risk. We're talking about mortgages here. We're talking about a collateralized, debt obligation here, and there's a lot of moving pieces behind the scenes, and so there's going to be a lot of, decisions and a lot of influence that Vantage and other score models are going to have to bring to justify their score model is as good or better than FICO. What I don't like about Vantage is that each one of the 3 major credit reporting agencies owns a piece of Vantage, and so why I don't like that is because Equifax, Experian, TransUnion, in my opinion, and their history of how they operate and conduct business, could lead to a way to help them influence and help Vantage gain market share. Is, let's say they don't want to switch, they want to keep FICO. I wouldn't put it past Equifax, Experian, or TransUnion to say something to the mortgage companies like, hey, well, we're going to probably raise the price on the reports. We're going to probably raise the price a couple bucks on the reports. But if you come to Vantage, we'll give you a discount, right? And so you can kind of save some costs on pulling credit reports if you're using a Vantage scoring platform. To say that would not happen, sure, there's a possibility that they may not do that. They may play fair, but I wouldn't put it past Equifax or Experian or TransUnion to do that, especially because they all own a piece of Vantage scoring systems. So another thing too is comparing FICO to Vantage is that besides the what it takes to get a FICO score, what it takes to get a Vantage score, is that FICO has also created industry option scores. And so what that means is you have your baseline, FICO score, but then you also have versions of that FICO that are tailored to fit the industry that you're seeking loan or credit in. So for example, if you're trying to apply for a mortgage, not only do you have a FICO score, but you also have what's called FICO Mortgage. It's kind of similar to the FICO Classic. It is the FICO Classic scores that I mentioned before, version 2.0 for Experian, 4 for TransUnion, 5 for Equifax. And there's an industry option, which is kind of an influencer, if you will, on that person's ability to pay a mortgage on time. So if you're someone who has, let's say, a 700 FICO credit score, but 6 years ago you had a foreclosure or a short sale, and you go and apply for a mortgage. Well, the industry option that's applied towards your FICO score probably is going to decrease your FICO mortgage score to some degree because you had that issue in the past, right? And that mortgage company is going to want to know what has been your history with mortgages in the past. They care about how you pay your credit cards. They care about how you pay your auto loans. They care if you don't have any collection accounts, or if you have, if you had collection accounts in the past, but they've been settled, they've been paid for some time. All that matters, but what matters, slightly more is, hey, what's been your history with paying mortgages on time? Have you had any defaults, any 30-day late, 60 days, 90 days, foreclosure, so on and so forth? And your history with that type of an account that you're applying for, whether it be mortgage, even in the auto industry, because in the auto industry, maybe you had a repo in the past or had some late pays on the auto loan, that history, that behavior you had with that particular account that relates to the industry that you're seeking credit for, seeking loan for, is going to bear influence on your final credit score. This is called your industry option that FICO created and put together because, of course, of the requests. Mortgage companies, auto companies are like, hey, it's cool. We want people's FICO scores. We need to know that to determine our approvals and who can we give a loan to, give a car to, give a house to. Of course, we need to know all that. But we also want to know, hey, what is their likelihood of defaulting on this particular type of debt, on a mortgage, on a car? I want to know a little bit more about that. How do we emphasize on that? Because let's say someone has excellent mortgage history, but they've had some issues with collections or some credit cards in the past. Yes, that does matter, it does tie into it, but this is someone that maybe I do want to take a risk on because they have paid a mortgage on time. They've never been late. So there's a strong possibility they're not going to pay me late. Me being a mortgage loan or me being an auto loan, right? And so Vantage is going to probably have to create something like that, create a little industry option model. I would think that the banks are going to ask them to hey, create something like that. Hey, FICO does this for us. Can you do that for that? Vantage hasn't already thought about that. I'm sure they have already thought about that, and they've probably already been putting it together because they've been waiting so long, building out so many models, so many versions, behind the scenes, waiting for this day, this moment to say, okay, great. Now we can go after the industry. Now we can go after the mortgage market, the auto market. Now we can finally go after that and get some market share. So they better have been thinking about this already. Otherwise, what have you been doing for such a long time? Again, FICO has been around since the 50s. Vantage is fairly new. Vantage has 4 models right now. Their latest model was 4.0. FICO has 10 models. I think up to 8. FICO 8 is actually being used. That's where, and FICO 8 is similar to Vantage 4.0. Vantage 4.0 includes rent, telecom, utility, and those accounts and those credit files. FICO 8 does as well with the Experian Boost now out there. Experian now will through a third party get access to, if you give them permission, which I don't agree with this, but people are doing it. They're given access to their bank account, their checking account. Experian is able to then get history up to 24 months, I believe, of utility type of history, cell phone, electricity, water, whatever, and then put that information on your credit report. So this is Experian Boost. This influences your FICO 8 score, which if you're trying to get a mortgage, again, remember earlier mortgage companies don't use version 8.0. They're using 2 through 5. But FICO does have this adopted into their scoring model to allow for this. So it just affects it just applies to the newer score versions of FICO. And as well as Vantage does ignore paid collections. Vantage does that FICO does as well in their newer versions. And so everything that Vantage is going to be bringing to the market and how to say we're better than FICO, trust us, use us, here's what we can do, FICO's already thought of, and FICO already has ready to go at a moment's notice. They're just waiting for that day that they have to go and say, when Vantage is going out there, hey, we don't consider paid collections. Hey, we can score people with only this amount of history. Hey, we do this. FICO is going to probably say, oh, that's cute. We got it too. We know how to do that as well. So, what's up? Why would someone want to switch when we have that same thing as well? So FICO's prepared for what's coming. Vantage has got a long road ahead, but this is a significant ruling for them that the FHFA now allows them to go in, validate and improve their model, then go after the market shortly after that. So probably about a 2 to 5 year process to where we'll start to see, Vantage start to collect some market share, start to compete, and it'll be interesting to see how this plays out in the next 2 to 5 years. And so next, I want to talk about Credit Sesame CEO. Says that the company is going to reach a unicorn status within the next few months, whatever that means, and has announced plans to launch or plans for an IPO. So, but first, before I get into that, I want to thank our partners at Identity IQ. So Identity IQ, if you are currently monitoring your credit through Credit Karma, you are missing out big time. Identity IQ provides you with a full, detailed consumer report from all 3 credit bureaus, not 2, just like Credit Karma does, and still provide you with your Vantage credit scores, which is the same credit scoring model that Credit Karma uses. Also, Identity IQ will provide you with a $1 million identity theft protection policy, dark web and internet monitoring, and an enhanced 3-bureau credit report monthly. This service is great. I use it for myself. It's a great tool to use if you're going to start repairing your credit. You want to track your credit. You want a lot of details about your credit report. A lot of details that you may not get from Credit Karma or other services alike. So for a limited time, my listeners can get 35% off the Secured Max plan and even get a 7-day trial for just $1. So my listeners can go to scores.com, that's ALL, scores.com to learn more and take advantage of the trial, plus get the discounted price to monitor your credit. So that's actually $1 for the 7-day trial and then $19.99 per month. So again, go to all 3 scores, that's the 3, to get started and start monitoring and protecting your credit report seriously. Again, all3scores.com to get the $1 trial and get 35% off the Secured Max plan price. Okay. So Credit Sesame CEO, his name's Adrian Nazari, he says that the company is going to reach a unicorn status within the next few months and has announced plans for an IPO. So they plan to go public. In my opinion, I do believe it's a little, premature. It's a little early. I don't really know what unicorn status means. I'm hoping that, with this article that I read, that it would, kind of specify what unicorn status is. The article was written by Kelly Early at SiliconRepublic.com, and didn't really see anything that specifies what unicorn status is. Of course, they're probably not going to reveal what that is just yet, probably because they're a privately held company at this point, probably want to keep it proprietary. But, some things that stuck out is that they recently just got another round of funding. They were able to raise $43 million in its last funding round. The funding round was led by ATW Partners. To this date, Credit Sesame has raised a total of $110 million, and they are one of the first companies. In fact, I do believe they're the first company to offer consumers free and monthly directly access to their credit reports. Credit Karma is a similar and comparable service where it's free to the user, and the way that they make their revenue, the way they make their money is through advertisers and affiliate programs, affiliate marketing. The only difference, I think, Credit Karma took it a step further and brought on Equifax to their platform. Started off with TransUnion, they brought on Equifax. Credit Sesame is only providing TransUnion access, no Equifax, no Experian. In fact, I don't think any free credit monitoring service out there provides Experian. I think Experian just does not want to play in this space. And so as far as unicorn status, in my opinion, what I've read is the company plans to put some of that funding that they received, the $43 million, to developing some more machine learning capabilities, AI, to, I guess, predict consumer behavior, and also to even help them expand into more data science, engineering, product and marketing teams out there in San Francisco, and Mountain View offices. And so, their plan is to focus, I guess, their go-to-market strategy, what's going to be, what's unique about them that Credit Karma is not doing or Quizzle is not doing, is the company plans to address the $14 trillion household debt issue in the U.S. So they're probably developing some type of platform, some type of, machine learning, some kind of algorithm that's going to help consumers pay off their debt faster. As far as what's out there, to services that are out there that are similar to that, I mean, there's credit counseling companies or debt consolidation companies. Credit counseling companies are typically third-party companies that will intervene. They have relationships with credit card companies already. They'll negotiate or get a lower interest rate. They force you to close out. You'll have to close out your credit cards, of course, but you'll be able to pay off your debt, a little bit faster. You pay a monthly payment to the credit counseling company, and then they disperse that payment to your credit card companies with the new negotiated rates. And it's a faster way to pay off your debt. The downside is, you do have to close out your credit cards that you have, which that will affect your credit score to some degree. And then you're paying a third-party company to administer this. In so many cases on the credit card trade line, in the comment section, it'll say, debt paid back or debt paid by third-party company, right? So usually that's going to show up on the line item on your credit report. There's debt consolidation companies or a debt consolidation loan, which can be rather difficult to obtain. Typically most banks want to see about a 640 credit score to get approved for a consolidation loan, sometimes a little bit higher with some other stipulations around that. And so many consumers who have overwhelming credit card debt, but don't have a lot of don't have a high credit score due to the fact they have a lot of debt, may not be able to qualify for a debt consolidation loan. There's debt settlements, which I'm not going to get into that. And, of course, just what your credit card companies are telling you, hey, if you pay this minimum payment, it's going to take you, this long to pay off your debt. And of course, the credit card company is not going to say, hey, if you pay this amount, you'll be off debt in no time, right? They're never going to promote that. Of course, they have to, appease the legislation that, at first and foremost, force them to put that on the credit card statement, the time frame it'll take to pay off the debt. But of course, credit card companies are not going to want you to pay off your debt too fast, too soon, because they make money in interest, and it's in their interest to have you paying on that credit card for such a long time. Really, if you can pay on that debt or be paying your interest or paying your minimum payment until you die, that's good for the credit card company. They would actually prefer that. Of course, they're not going to say that, but I mean, at the end of the day, it's a for-profit industry. That's how they make their money. So the other way to pay off your debt faster is just make a budget for yourself, apply more money towards your principal, towards your balance, just, kind of cut costs every way possible, find ways to earn a little bit more income, maybe pick up a second or a third job, just kind of get on a strict budget, and, you can pay off your debt within, 2 to maybe 4 months, depending on how much, 2 to 4 years rather, depending on how much debt you actually have. But Credit Sesame is coming up with a idea or a platform that's going to address the $1 trillion household debt that all consumers are facing in the U.S. Maybe that's what they're claiming is going to give them that unicorn status. This is maybe something that what they're putting together has never been done, has never been tried. They're going to actually do it, and it's going to, eliminate or significantly reduce the consumer household debt in America. We'll see. Besides that, I don't really see anything else that would, give them this unicorn status because, they've only been around since 2010, so less than 10 years in existence. They have 100 employees. They have thousands of employees. They have 100 employees. They are only providing data from TransUnion. They're providing a Vantage score model. The revenue share, the revenue is pretty much similar to Credit Karma because to the user, to you and I, the consumer, the service is free to get on Credit Sesame, to get on Credit Karma. It's free to do that. But where they're making their money is, of course, through advertisers as well as affiliate marketing, such as if they'll allow Chase, Capital One, other credit card companies to promote their credit card based on, like, instead of credit card companies getting data from the bureaus and then sending mailers for pre-screened offers, they can say, come onto this platform and say, hey, we'll give you the data much faster, much easier. And when someone reaches that threshold of a certain score, then your ad will stick out. And then anytime someone applies and gets approved for a credit card, or someone clicks on the ad, me, Credit Sesame or Credit Karma, then I get paid. And that's how they make their money. So that's coming. They plan to go public. They're a privately held company. They've only been around for about 9 years. But they have something up their sleeve. They claim to be, have something that is going to put them in unicorn status, and I guess time will tell. But pretty interesting that Credit Sesame wants to go public. They believe they're ready to go public. So, we'll see what that shapes out to be. Next, I'll talk about an Illinois-based debt collector that enters into a consent order with the CFPB and then settles, the alleged FDCPA and UDAP violations. But first, I want to thank our partners at GetSecuredCards.com. If you're new to credit, or even if you wrecked your credit years back, getting back on track and rebuilding credit can be rather difficult, especially when the credit card companies don't want to give you a credit card because they don't want to take that risk. So how do you rebuild credit? How do you rebuild credit character when you're not really given a second chance to do that? Well, our friends at GetSecuredCards.com can help you get the credit you need and deserve to begin restoring and rebuilding your credit score. From over dozens of cards to choose from, like Open Sky, First Progress, you can pick the card that best suits your budget and your life. What I like about this website is it tells you everything you need to know. It tells you what the interest rate is. It tells you if they have any annual fees. Tells you, what you need to do to get approved. There are any credit checks or not. It's really cool. It gives you all the underwriting guidelines up front, and you decide which credit card is going to be best for you to start rebuilding credit with. Also on this website, there's other similar services like a jewelry online account. There's a student credit card you can get if you have no credit, want to start building credit, and don't want to have a secured card, maybe a cheaper card to get started. And so again, go to GetSecuredCards.com. Start rebuilding your credit with a secured card or even a starter credit card, and begin to rebuild your credit this way. Again, go to GetSecuredCards.com, explore all the options you have, and start building credit today. Okay, so again, the CFPB entered into a consent order with the Illinois-based debt collection company. So this collection company actually bought mostly retail debt, credit card debt, and that's typically what they collected on. So the company was actually ordered to pay $37,000 in restitution to the customers, or to the clients, or the debtors, I guess, and another $200,000 to the CFPB. Pretty unbalanced number. $37,000 to the victims, and then $200,000 to the Consumer Financial Protection Bureau. And so what they were caught doing, or what they were accused and convicted of, was violating the FDCPA and the UDAP, the UDAP. And so what they were doing, what they got caught doing, was threatening consumers with arrest, lawsuits, liens on home, garnishment of consumers' bank account or wages. And so, this is actually, it's not rare, it's not that common, but there are still debt collectors that do this because they get away with it. The average consumer does not know that a debt collector cannot threaten them with arrest warrants or, bank levies, garnishment, lawsuits. I can't tell you how many phone calls we received here at the credit agents from consumers who are just frantic. They got called at work by a debt collector or at home where they called a relative and say, hey, they're looking for me. They're going to probably put me in jail. They're going to come and arrest me. I'm scared for my life. What do I do? And there's certain things that debt collectors can and cannot do, and this is one of them that they cannot do. They cannot threaten you with an empty threat. Like if they're going to send, like let's say they're going to sue you, okay? They can say, hey, we may turn this file to an attorney, or if they do say they're going to sue you, they need to follow through with it. If they don't follow through with the lawsuit, it's an empty threat, and it was just a threat to intimidate you into paying. That would violate the FDCPA, the Fair Debt Collection Practices Act. And so, but they can't take you to jail over consumer debt that is unpaid. I mean, that stopped years ago. That's one of the main reasons why a lot of people, from Europe and Britain immigrated to the U.S. was also to escape the harsh rules that existed for unpaid debt to merchants. If you didn't pay your debt, there was a debtor jail back in the day, hundreds of years ago, right? And in America, that does not exist today. There is no debtor jail. I mean, of course, the type of jail you can probably go to for unpaid debt would probably be taxes. If you don't pay your taxes for quite some time and you're just, avoiding taxes, then of course the IRS will probably prosecute you, and then you'll go to prison for evading taxes and not paying your taxes. And I think child support, if you don't pay your child support for a certain period of time, not too sure on that, but I know for a fact that
I haven't really heard of anybody going to jail over unpaid child support,
but I know people do go to jail for not paying their taxes. But other than that, if you don't pay your credit card, you don't pay your car loan, you don't pay your mortgage, and there's a debt collector trying to collect, they're harassing you, they're calling you, they're trying to collect. And if they say they're going to take you to jail or you're going to get arrested, that's not true. That's an empty threat, and they're just trying to intimidate you into paying. Again, there is no such thing as debtor jail. That was done away in the 1700s, 1800s, somewhere around there, and that was in another country. Okay, that was in another foreign land that people escaped from to come to the great land of America, because there was a debtor jail. If you didn't pay your merchant, if you didn't pay the shoemaker or the vendor, the store, the corner store, the general store, whatever, and you owed them a debt, and they were trying to collect, and they could not collect, then they could throw you in jail for not paying your debts. But that does not exist in America, so nothing to worry about there. Also, the Illinois Debt Collection Company represented that a non-attorney company, that the employees were attorneys. So they're, saying that some of the employees there were attorneys, and in fact that they weren't. And even though that the company does not employ attorneys to collect the debt, to take legal action against the debtors, they were claiming that they had attorneys on staff, or maybe some of them, when they were making the phone calls, were saying, hey, I'm an attorney. If they were doing that, just FYI, an attorney is not going to call you for an unpaid debt. They really communicate via mail. They'll just slap a lawsuit on you. Hey, we're going to take you to court for this unpaid debt. And that's typically how an actual attorney will communicate. An attorney to pick up the phone, call you, hey, I'm an attorney, you owe my client money, you need to pay. It's not really a professional attorney. In fact, a lot of them, I don't believe they can even do that. I think there's laws that prevent attorneys from making outbound calls, like ambulance chasers and things like that. They can't solicit their business, which I guess that wouldn't really be soliciting business. But, an attorney is not going to pick up the phone and call you to collect an unpaid debt for one of their clients. They're going to communicate via mail, probably send you a notice in the mail. Hey, we're going to take you to court if you don't do something, if you don't pay the debt. And then you don't pay the debt, then they'll actually file the lawsuit. Then you're served paperwork by a constable or a sheriff or a process server. And then you have a court date. And then you're going to go to court and, make your case in front of the judge. And then the judge will decide whether or not, you owe the debt, how much you owe, is there a settlement possibility, et cetera, et cetera. But an attorney is not going to call you for an unpaid debt. And apparently this company had either employees that were claiming they were attorneys, or or maybe just mentioned it that they had attorneys, but in fact, the CPB found that they didn't. And also, what they also did is they represented that consumers' credit reports would be negatively impacted if they did not pay, even though the company does not furnish information to consumer reporting agencies. And so, if you have a debt, it goes unpaid. A debt collector starts trying to collect on the debt. One of their ways to collect, besides annoying phone calls, emails, texts, notices in the mail, is they report the negative information on your credit report. It'll be listed as a collection account. They'll put their company name, the original creditor, the amount you owe, and it would go on your credit report, which would negatively impact your credit score. And some debt collectors don't even call, they don't even communicate. The way they communicate is that just park the debt on your credit report. You see it, and like, oh my God, I have a collection on my report. Who is this? What the? Let me call them instead and see what's going on, right? That's typically how some debt collectors, that's their way of collecting debt, is they'll just stick it on your credit and wait for you to call them, so they don't spend the money on people calling you and trying to harass you and dealing with all of that. They'll just throw it on your credit because they have a right to, and you just call them when you're ready to deal with it. And so this company was actually telling consumers, like, hey, if you don't pay, this is going to impact your credit score negatively. And they weren't actually sending information to the credit reporting agencies. And so that was another empty threat, empty promise to manipulate people into making a payment, because you have people that are paying their debts off which is a good thing to do. Definitely always pay your debts back, pay off what you owe, but they were manipulated into thinking like, well, if I don't pay, then they're going to report bad information in my credit report. I don't want that to happen. And this would be okay if they actually were doing that, right? This would be completely legal if they actually were following through with reporting information to the consumer reporting agencies, to Equifax, Experian, TransUnion, whoever. This would be okay. They would have allowed for this to occur. This would have not been an issue if they were actually doing it. The problem is they were telling the consumers, if you don't pay, negative information can appear in your credit report, or we're going to report bad information in your credit report, but they weren't actually ever doing that. So it was another one of those empty promises, those false threats that did not actually exist. And so I just kind of want to leave it there in little word of advice, little word of encouragement when it comes to debt collection practices and things that exist. I mean, the FDCPA has been around for the 70s, so it's been around for quite some time. And if there are attorneys that would happily take a case like this on, and you as a consumer, if you fall, victim, or you believe you're a victim of a FDCPA violation, well, you have the right to contact an attorney. Many attorneys, if you provide them with physical evidence, maybe a letter in the mail, or a recorded call, or an email, or a text, something that proves that they're violating the FDCPA, many attorneys would take that on free of charge to you. They'll then go after the debt collector, and in the settlement or in the violation, which each consumer is able to receive up to $1,000 per infraction, many of the attorneys get paid on the back end, right, from the settlement or from the suit or whatever happens, and then you get your fair share at the end of the day from whatever the attorney can collect from the collection agency that is infringing on your rights under the FDCPA. So some other things that they can and cannot do: they can't call you before 8 a.m. your time, not their time, or after 9 p.m. your time. You have to call you within that time frame. They cannot pretend to be law enforcement. They cannot pretend to be an attorney, which is what this company got in trouble for. They can't make empty threats to you. Hey, we're gonna sue you, and then they don't actually sue you, or we're gonna take you to court. We don't take you to court. We're gonna report bad information on your credit. They don't actually do that. That'd be an empty threat. They can't do that. They can't speak to anybody else about the debt. They can call your mother, father, husband, wife, brother, sister, and say, hey, we're trying to locate so-and-so. Do you know where they're at? Blah, blah, blah. They can do that, but they can't go into the specifics of, hey, well, they owe us a debt and we're trying to collect the debt. That'd be a violation of privacy. They can't reveal that to other people. They can call other people and just try to locate you or try to get a last known address or contact. They can do that, but they just can't dive into the nature of what they're calling for. So those are some most commonly violated FDCPA violations. Something to think about, something to be on the lookout for. Again, there are attorneys out there that will gladly take this on and work towards not only getting you forgiven from the debt if the item is on your credit report, getting the item removed from your credit report, but also putting some money back in your pocket. In fact, here at the Credit Agents, we have affiliated ourselves with attorneys that specialize in that, so we can refer good cases like this to us. And so if you believe you have a case here, if you believe you have, your rights are possibly being violated under the FDCPA, and you're in Texas, so we're in Texas, and so only if you're in Texas, because we have our network of attorneys here in Texas, then give us a call, 800-786-2120, or go to our website, thecreditagents.com, and put your contact information, just put in there, hey, I think I got an FDCPA case I'd like to have looked at. And one of our team members here will gladly get on the phone with you, discuss all the details, and if we think that there's something there, we'll get you referred to one of our attorneys and kind of begin that process for you. All right, so that is my time today. We'll kind of leave it there. I will see you guys on the next one. Until then, God bless, take it easy, and thanks for joining.